Well, it is aftermarket on Thursday, and as I sometimes do on Fridays when I'm tired and don't feel like typing, I thought I would turn to the camera tonight and talk about a couple of things as the summer really winds down. This is the first week in September, but for all intents and purposes, this is the last week of summer trading, or it should be anyway, even though we had a taste of it on Monday. And expect the market to pick back up in full gear on Tuesday after the states celebrate the long Labor Day weekend. But a couple of things going on that I thought would be a good reason to turn to the camera a little bit tonight. Sometimes I can get thoughts across better via video. And for those of you that were not aware, we did do a webinar. Obviously, it was posted here in the blog over at Online Trader Central last night. That was put on by the HotCom folks. That is the intraday audio chat that the Jellies use. And as I mentioned in last night's post, we had a remarkable turnout, 668 people from 45 countries. And I basically was given an hour to talk and try to cram as much into that hour as possible. I've gotten a lot of mail, and everybody who attended should have gotten a follow-up note from me. And I know there were a lot of questions in terms of whether it was recorded or not, and it was not recorded because it was intended as a live presentation. So what I thought I would do, though, in today's video, in the short time that we have, I get 10 minutes, as well as in a couple of the slides, which I'll attach in today's post as well, is just talk about a couple of the concepts that we talked about last night if you weren't able to make it. So. One of the concepts that we talked about, and by the way, these are excerpts from the Jelly study and preparation sessions. But one of the concepts that we talked about was that of a three-line break. And if you're not familiar with three-line break is a non-time-based trending mechanism, if you will. Steve Nissen talks about it quite a bit in his Beyond Candlesticks book. Got a great chapter on it. And you'll see in the slide here, if you want to bring that up and perhaps print it off while I'm talking here. The first slide really shows you what it's all about. And now when I say it's non-time based, basically it requires the market to change price a certain extent before it will create another bar. So if the market were never to change price or never to change the current range, leave the current range of its price, then there would never be another bar created, even if the market traded all day long. And that's the concept of three-line break. It's also referred to as three-point break, three-price break, and in fact, if you use TradeStation, they call it line break, and then you can set the parameters that dictate the number of bars that you want it to count. But essentially, that's what it is. So if you look at the top slide, basically says if three consecutive bars, then the price has to close below the low of the last three bars if you're looking for a turn south. Or above the high of the last three bars if you're looking for turn north, and you see that in the or on the slide as noted by the purple lines. I've drawn and superimposed the purple lines on top of the E-signal chart, and basically that's what it is. As the slide says, it's an indicator which is completely non-arbitrary. It is 100% market and price driven. You don't need to guess. You don't need to do anything more fancy than look at what that's telling you. Now, as I told the people last night, as I tell the Jellies, any indicator by itself is completely useless. There have been a lot of studies done on the fact that moving averages don't work, or stochastics don't work, or this, that, and this doesn't work. And the fact is, all those studies are probably right. They don't work. But the key is they don't work by themselves. Okay. The way that I've always traded, the way that I've always tried to interpret the market and the pulse of the market is to combine all the indicators, and there aren't a whole lot of them, but combine them and see what that's trying to tell you. So, like any indicator, it can be pretty dangerous by itself, but in combination with other tools such as tick and price charts, it can be extremely helpful. The next slide, I talk a little bit about the benefits and uses. Benefits: it eliminates the bar chart noise. Provides a reversal trigger for an extended trend if the other indicators confirm. It provides what I call an excellent trade sequence stop premise. It clearly can set a premise-based stop price in terms of if you're shorting against a reversal or going long against a reversal, you know that you know so long as the market continues as it is and the three-line break chart does not reverse, you're in okay shape. By the way, one thing I should point out is it is not just a price probe above that last high or low that triggers the change. It is a price close. Okay, and that's one of the benefits of this. It eliminates a lot of the noise, and it reflects the price needing to close at the end of the period. So after a minute, if you're looking at a 1 minute chart, which is what this is, okay, it will measure the price, and if it has not exceeded, you know, that 3-bar price on a closing basis or flip-flop on the other side, then it will not reverse, and you'll see a continued trend. So as noisy as the markets have been over the summer, been very, very helpful. I showed last night several instances, including Monday morning's BARF, where there are some very strong signals in terms of weakening in the opening session on the fake move up, as well as what I call a stay out of trouble indicator. Speaking of stay out of trouble, soot is a term that we use in the tank. Reflects to staying out of trouble. Even if you're not trading with it, it's a great indicator that tells you, you know, you shouldn't yet be shorting, even though it looks like a short, or you shouldn't be yet going long, unless you're taking contra trend extreme scalps, which is something that we also do. So if you're looking for reversals, though, great stay out of trouble indicator. Cautions says here limited help in choppy range-bound markets, although that in and of itself can be helpful. You know, it tells you basically you're not trending. And one of the things is that the reversal trigger. A reversal indicator often triggers after the new trend has gotten underway. And that's not necessarily a bad thing. That can result in you paying a risk premium, a confirmation premium to get in on a reversal. And many traders, if they're trading that particular pattern, will want to pay for that. So that's not a big deal. And if you're real conservative, you can wait for a turn and then you know, wait for a retracement back toward the other way, so you're closer to your stop premise before entering. So that's another way to do it. So those are a couple of thoughts on three-line break. And you know, I might do another one of these on tick at some point down the road too. So that was one of the big ones that we talked about last night. So I just want to throw that up on the blog for everybody to take a look at. A large welcome, of course, to those attending the webinar that are stopping by the blog. We had another tremendous spike in traffic over the past couple of days, and I just wanted to remind you, you know, what this is all about. This has been a diary really that's been going on for over a year, since July of '08. I really encourage you to check out the key post menu in the lower left-hand corner of the blog, or lower left-hand side, if you're looking for something to read. I think that'll give you basically help give you your bearings in terms of what the site is about. It reflects some of the more significant posts that I thought were pretty key, or others thought were pretty key. But a month or so ago, I did turn the comment feature off. I just didn't have enough energy really with the jelly effort, and it was kind of turning into a online chat forum, which was never the intent. The intent was always to use it as a diary, to use it as my way to document thoughts to myself and get points across to others. You'll see there are a lot of movie analogies, sports analogies. I do believe trading is a sport. You'll see that theme throughout. I try to use a lot of parables and analogies to make trading hit home for everybody. So again, if you're new here, welcome. This thing took on a life of its own. Never expected it, and you know, we're gonna pick it back up in September. Jelly effort has 3 more weeks to go. Again, I keep getting questions, that I got flooded with emails last night after the session, asking if I'm going to do another jelly effort. I don't know. You can refer to my last video in terms of my desire to continue in some way with the guys that are training together right now. A lot of goods happening there, and you know, all doors are open right now. So I'm a trader first and foremost. I always have been, always will. Got back into education at the request of the trading community, and have decided to do that as best I can. So again, just a reminder too for the people attending the webinar last night, if you want to be included in the Jelly webinars, that I'm going to include a half-hour phone call as well. Not a salesy thing. It basically reflects the fact that the first 5 were recorded, but you couldn't interact live. So that's what that's all about. And if you want to let me know by the end of this weekend, that'll be great. My 10 minutes are almost up. Have a great weekend if I don't catch you tomorrow. And again, welcome everybody. Thanks for your attention last night. Hope this helps today. Take care.